All right, let's get right into it. Something massive is happening in the world of digital finance. And you know what? It goes way beyond just the simple idea of buying and holding Bitcoin. We're talking about a completely new playbook that's just now starting to unfold. I want to start with this quote from Michael Saylor because it just perfectly captures the moment we're in. For years, you had all this regulatory pressure holding Bitcoin down, just like a beach ball being forced underwater. But now, all of a sudden, that pressure is gone. And that beach ball, it is shooting to the surface. Understanding that explosive force is what this is all about. So, what is this big change, really? Well, it all comes down to a fundamental misunderstanding of what the most sophisticated companies are actually doing with their Bitcoin. We're seeing a huge shift from a passive, just hold it strategy to a really active and honestly a very creative one. You see, most people, when they think about a company with a huge Bitcoin treasury, they imagine the strategy is super simple. Buy Bitcoin, stick it on the balance sheet, and just wait for the price to go up. But that's not the whole story. Not even close. The reality is so much more innovative than that. Okay, this is where it gets really interesting. For a traditional company, let's say a car manufacturer, their product is the car. Debt is just a tool they have to use, a necessary evil to build the factories. But in this new Bitcoin playbook, the credit instruments themselves, the bonds, the preferred shares, that is the product. They aren't raising debt because they're desperate for cash. They are literally in the business of creating and selling high-yield credit. It's a total flip of the script. So you're probably asking, what on earth made this new model possible? Well, it wasn't just one thing. It was this perfect storm, a convergence of five huge catalysts that, to go back to our metaphor, finally took the hands off that beach ball and just let it fly. And what's just incredible is how these five different shifts all happened pretty much at the same time. First, the entire regulatory scene just flipped. Hostile regulators got replaced, and these restrictive rules that made it tough for banks to hold crypto got thrown out. Second, you have the mortgage giants, Fannie Mae and Freddie Mac, starting to recognize Bitcoin. Third, huge banks suddenly started offering massive credit lines against Bitcoin. Fourth, Wall Street started building the on-ramps for the absolutely enormous $300 trillion fixed income market. And to top it all off, this all happened right as general adoption hit that steep exponential part of the S-curve. It was the convergence of everything at once. So, with all that resistance just gone, what does that beach ball shooting to the surface actually look like in the real financial world? Well, it looks like a solution to one of the biggest problems facing savers and investors on the planet right now. And it all starts with solving this massive problem. There is $30 trillion just sitting in U.S. bank accounts and money markets, and it's basically losing a little bit of its value every single day. And this chart right here shows you exactly why. I mean, look at it. When the average yield you can get by playing it safe in a bank is the same as the inflation rate, or even lower, you are absolutely guaranteed to lose purchasing power. Your money is worth less tomorrow than it is today, period. And listen, this isn't just some abstract economic theory. This is a very real, very personal challenge for hundreds of millions of people who are trying to plan for their future, trying to live comfortably in retirement. The question is simple. How do you find any kind of decent yield in a world with no yield? So the solution that's being put forward is a brand new kind of financial product. Saylor compares it to kerosene. Back in the day, Standard Oil took crude oil and refined it into all sorts of things, but kerosene was the pure, high-value energy source. In the same way, these companies are taking volatile Bitcoin and refining it into something stable, a high-yield credit instrument. And when you put them side by side, the difference is just, wow, it's night and day. You're talking about maybe triple the yield with incredibly low volatility. We're talking 0.5% swing. Plus, it's backed by collateral worth multiples of the actual value, and it has a better tax structure. It's really designed from the ground up to be a superior alternative. So how does this actually work? It's not magic. It's just a really innovative kind of arbitrage. The company uses Bitcoin, this high-growth asset, as its collateral. Then it issues a credit instrument that costs them, say, 10%. But because the underlying Bitcoin is appreciating so much faster than that, they get to capture that huge spread in the middle. It's a way to basically harness Bitcoin's powerful growth to create stable, predictable yield. So what does this all mean for the future of finance? Well, if this model really takes off like it could, we might be on the verge of what's being called a Cambrian explosion of financial innovation, a whole new era. And this is not about one single company dominating the market. No, the idea is that this playbook can be used by anyone, anywhere, creating an entire global ecosystem. We could see thousands of new companies pop up specializing in different markets, different currencies, different kinds of credit products, all of them built on this exact same foundation. And the speed of this new model is it's mind-boggling. Think about it. It can take years to finance and build a skyscraper. But here, as Saylor points out, $1 billion in capital can be raised and put to work in a single day. The whole investment cycle is moving 1,000 times faster than in traditional industries. Now, I know what you might be thinking, this sounds a little too good to be true, right? Who's on the losing side of this whole deal? Well, the beauty of this model, at least as it's being presented, is that it's designed to be a positive-sum game, which is a huge change from the old zero-sum financial system. I mean, when you really break it down, everybody seems to get something they need. Retirees get that high-yield, low-risk income they've been desperate for. Companies get a way better return on their treasury than just letting cash get eaten by inflation, and the entire economy benefits because capital starts flowing much more efficiently to where it can actually create value. And that really just leaves us with one final, pretty provocative thought. If this new way of creating digital credit truly takes hold, are we actually witnessing right now the birth of the next JP Morgan, the next Goldman Sachs? The companies that figure out how to master this new playbook could very well become the dominant financial giants of the 21st century.